Coming up today, the selling in stocks intensifies as we quickly approach Liberation Day. Are we on the cusp of a recession? Is the US bull run over? Consumer sentiment drops again, inflation comes in hot, and are we on the cusp of one of the most significant events in global financial markets we haven't seen for years? You don't want to miss this one, guys. Let's go. $1.25 trillion was wiped off the stock market today on a bit of a nasty finish here going into the weekend, and not all that surprising going into next Wednesday. Liberation Day, global reciprocal tariffs set to kick off. The market is definitely weak here. Going into this massive event, growth and tech shares taking it on the nose again here today, including financials, whilst we've still got a little bit of a defensive rotations. Utilities perking up a little bit there. No surprise either, we've gone back into extreme fear, finishing the week at 22. We've now had extreme fear for over a month. This peak pessimism is continuing as the market is absolutely fixated on looming tariffs next week, clearly the dominant factor in global financial markets. As we round out Q1, and the calls for a recession are growing louder and louder all throughout the media. This article saying it's time to hedge America and advisors buying some put options, which is exactly what a lot of people did today. Just looking at the options volume leaderboard, almost double the amount of puts were traded today than calls. Looking in the spider, same deal with the Qs, over $1 billion in puts, as there appears to be a lot of hedging going on in the indices. And as you can see, all the most popular traded stocks and ETFs coming off quite sharply today. The only three assets in the leaderboard holding up was AppLovin after they got smashed down 20% yesterday, with a bunch of hedge funds ganging up on them, publishing short reports on them. But then many analysts coming out along with the company and biting back, giving us a bit of a bounce there today. Otherwise, it was once again gold holding up and actually a bit of a flight to safety in treasuries as yields came off a bit today, all of which I'll get into later. But we have seen a little bit of an increase in the odds of what various markets are pricing of the chances we see a recession in the States this year. Just looking at Polymarket here, bumping up to 37%, and just looking at Kalshi prediction markets, now pricing about a 41% chance we see a recession in the States this year. However, whilst it's definitely increased pretty much ever since Inauguration Day back in late January there, it's still a bit below where we were prior to the election, 52% chance. But there is just so much bearishness out there, almost like we're trying to talk ourselves into a recession and a bear market. Now gone 5 straight weeks with the investor sentiment survey, over 50% in bearish readings. That's approaching an all-time record and is typically a good contrarian signal. But I agree, the chart does look weak here. Just looking at the SPY finishing on the lows, completely taking out that gap we got to start the week. But the bulk of the selling was in mega cap tech. Looking at the MAGS ETF, down over 3.5% today, and next week is definitely going to be pivotal, not only fundamentally, with tariffs set to kick off on Wednesday. Are we going to get some last minute deals? Are we going to see the state's major trading partners bite back and announce their new retaliatory tariffs, escalating a global trade war? In addition to technically the MAG 7 in the indices coming down to retest those lows from last week. So we're going to dive into all of this and a lot more today in this video. I'll give you the bird's eye view, present both bullish and bearish data, and I'll let you decide what to make of it all. And you're welcome to share your thoughts in the comments below this video. And stick with me today, because later in this video, I'll also show you the best performing large cap tech stock that is actually up 17% so far this year, and why I'm continuing to invest in it myself, along with showing you some key developments that have just happened in this company. And I'll also provide an update later on what happens to this entrepreneur shares ETF when SpaceX, its top holding, IPOs and comes onto the market, and also what happens if this fund's position in SpaceX exceeds their 15% limit for private holdings in the ETF. But first, just to get you updated on key markets, let's just take a look at volatility here. Obviously getting quite a bit of a perk up in the VIX index, 21.6. Above 20 is typically when the market's nervous. There's a bit of a line in the sand, and we are now back in the dicey zone. Front month VIX futures back above the second month, indicating option dealers are forecasting a lot more volatility right in front of us compared to a month from now. And that's why my market risk on off indicator has gone back into the red today, as we can see shaded on the chart here. And we can see looking at the sector trends, mostly red across the board. In fact, we've got the major indices below their 200-day moving averages now, as we have yet to stage a proper recovery and follow through. We've bounced back up to the 20 MAs and rolled over a bit here, coming down to retest those lows from a week and a half ago. But it hasn't been a complete washout, as we can see the defensive sectors somewhat holding up along with energy as well, and of course gold, has been one of the places to hide out throughout all this. But just going out to a clean weekly chart here, like I was saying yesterday, we have seen these extended pullbacks in the market before, especially in Q3 2023. We can get a few lower lows and lower swing highs, but until we get that really sharp V-shaped bottom and push, and the market kind of grinds up, we could very well consolidate throughout Q2. And as I was saying yesterday, we very well may come down and test this next key level, just above 5,400 on the S&P 500 index here, where the market has turned a few times before. But on the other hand, it's still possible we could get some positive developments next week on tariffs, maybe some last minute deals. And I'll show you some news out today that potentially alludes to that. And then if so, the market could very well make a double bottom here, as we do have some bullish divergences building, looking at a few of my indicators. Not only my S&P 500 oscillator here, but also on the SPY, looking at my dynamic swing index, DSI, is currently showing a bit of a sharp bullish divergence. But I'd say it's very likely we're going to at least come down and retest 551 come Monday or Tuesday. But the market is really good at kind of just running a little bit past prior swing highs, prior swing lows, taking out some stops before reversing again. So the first few trading days of next week will be pivotal and very interesting. Going into Wednesday, April 2nd tariff. And I mean, I do get it, why people are concerned out there and nervous. But if you really believe the new administration is intentionally trying to destroy the economy and the stock market, then I guess it makes sense to get out of the market. However, that's not the way I see it. I don't think they're intentionally trying to destroy the economy. Maybe it's more of a large structural change for sure. And no doubt their actions are causing plenty of volatility here. It's a great time if you're an options trader. But if it really started to look like their actions were going to cause a recession or a sharp crash in the stock market, I think we would get a very large White House put in short order that would come into effect, potentially in tandem with the Fed to backstop it all. But I know not many people are buying that argument. In fact, there's a continuing and building narrative that US exceptionalism has paused, some even claiming it's now over, with even Citigroup recently coming out and saying investors should load up on Chinese stocks. And I mean, hasn't that been a contrarian trade so far this year? Just looking at the spread here between the Chinese large cap ETF, FXI, and the American Spider, can see that bump up in Chinese stocks relative to American stocks on initial news of massive stimulus last year. Then we got just as big a pullback coming into this year, especially after the election, as the market got nervous. What are tariffs going to do to China? Big consensus that China was going to get slammed, but the market's gone completely the other way. And in fact, ever since inauguration of the new US president, the spread between Chinese and American stocks has increased over 26%. Has been the outperformance of Chinese stocks relative to American stocks year to date. And that's because FXI is actually up quite a bit year to date. Well, of course, the Spider is down. But now we've got Wall Street banks saying this is the trade to get into. Are they right or are they a little bit late? What do you think? Do you think American exceptionalism's over? Because the White House is trying to level the global playing field for tariffs. If we are going into a nasty global trade war, do you think America's going to lose it? Do you think Europe might win? What do you think the likely outcomes are of all this? I'm interested to hear your thoughts. Because in my opinion, I don't only think American exceptionalism isn't going away, I think it's actually accelerating, as crazy as that might sound. And in addition to many reasons why America is the home of global capital and is exceptional, especially when it comes to financial markets, is this chart right here. The growth investment ratio, which basically looks on companies' capital expenditure on growth, research and development, divided by the cash flow from their operations. America significantly ahead of other global equity market. And that gap's actually widened over the last decade. And basically what this shows is American companies invest a lot more of their cash flow back into growth initiatives, back into innovation, creating new technology. And you might naturally think, well, that would cause lower margins versus the rest of the world. However, in reality, not only can American companies invest a larger percentage of their cash flow into research and development, but they can do so whilst maintaining high levels of return on equity, what investors get back from the company, which again, that gap has widened over the last decade with the rest of the world. You can see here the states in the black line, currently averaging around a 17% return on equity, while the rest of the developed world is around 10%. In other words, with American companies, just as we've seen in the last decade, you're getting more innovation with a higher return on your equity invested. But somehow now the narrative is this has all changed overnight because of a new president trying to level the playing field on tariffs. And why I believe American exceptionalism is not only holding up but accelerating is because the industry of the now and the future, artificial intelligence, automation and robotics, is still advancing at light speed. We just heard today the first data center complex for OpenAI's $100 billion Stargate infrastructure infrastructure venture will have space for as many as 400,000 NVIDIA GPUs, which if filled would make it the largest known cluster of AI compute power, not to mention XAI, also speaking about eventually getting to a million GPUs. And so just looking at the stock price of NVIDIA, actually holding up a bit better than the rest of the tech sector there today, only down 1.5%. But it's now getting down into the low 20s on a forward PE, whilst industry analysts are still expecting earnings to grow north of 40% next year and beyond. But somehow tariffs completely erase everything to do with AI and robotics, or at least it appears that way in the short term, right? There's always a dominant factor in markets, but they don't last forever. We always eventually switch from one narrative to the other. I think even if a global trade war does go on, the market will eventually digest it and get used to it. Then we'll move on to talking about something else every day. And I believe ultimately we will get deals done. We just heard from the president that he just spoke with the leader of Canada, saying it was an extremely productive call. They agree on many things and they've still got a lot to work on. And it will end up being great for both countries. And so just keep that in mind. He does identify as a negotiator. And the good thing about tariffs is they're very elastic. They're very interchangeable, can come and go with a stroke of a pen, potentially opening the door for China to get a deal done and tie it in with TikTok. And who knows, potentially in Q2, they could all get together for a special global trade deal announcement that, like I've been saying, might actually open up global trade like we've never seen before. Because pretty much every other country around the world places higher tariffs on US goods than vice versa. The end result of all this could be the global tariff average comes down, because fate does love irony. But we can't seem to win either way. If there's not recession fears, it's stagflation. Economy goes sideways whilst inflation goes up. And no doubt that is on plenty of people's minds. We just got the latest University of Michigan's Consumer Sentiment Survey coming in the lowest since 2022. And there's a look at the hard data on a 1-year chart. Quite a sharp fall there, down to 57. But just putting it into context over 3 years, similar readings to early 23, late 22, and going out 10 years, still definitely well off pre-2020 levels for sure. And no doubt a little bit exacerbated today by Lululemon, which sells premium priced athleisure apparel, spooking the market a bit here today as they did beat on expectations, but the CEO saying they did see slower traffic in the first quarter, saying consumers are spending less due to increased concerns about inflation and the economy. And so that's what the market's worried about. Are all these weak consumer sentiment surveys actually going to translate into consumers tightening up on their spending? Stock did get whacked down over 14% there today, and the whole retail sector has been in the toilet this year. And not helping the picture was core PCE inflation, coming in a touch higher than expected on an annual clip of 2.8%. But us looking at the raw data, we're not breaking out on the chart here. In fact, just looking over the past year, we've actually had 6 other months with the same or a higher reading, and just putting it into context over 10 years. I would still argue, for the here and now at least, inflation is still tracking sideways. It is not uptrending, nor is it downtrending. But of course, consumers' expectations of what inflation is going to do over the next year have exploded to the upside. Again, here today, coming in at 5%, and just zooming out to 10 years there, inflation expectations had peaked back in April 22, had been coming down with a sharp rise, but remember, there's a big political element in these surveys. They're done online, and the majority of respondents in this survey identify as Democrats, which understandably, those mainstream media channels have been coming out with a lot of fear-based headlines. So we've got a big divergence going on right now with what a lot of consumers think inflation's going to do and what the Fed's likely to do next. They're still very much on pause, undecided. Some people are saying the Fed easing cycle's done. Some people are saying their next move's going to have to be up. However, even though we're getting some conflicting messages from Fed presidents themselves, we just heard from San Francisco Fed President Mary Daly today, who still thinks they'll get 2 rate cuts done this year, and that growth in the labor market remains solid. And we've got a massive divergence between what people expect inflation to be and how it's actually tracking in real time, looking at thousands of prices across the real economy. Still under 2% here on Trueflation. And in fact, Fed Fund futures increased the probability that the Fed will cut in June, now giving us over a 75% chance they're going to move to the downside shortly, which, just like the panic we had in the bond market in Q3 last year, it's a great excuse for the Fed to get some cuts done. It took advantage of that and did a 50 basis point cut. So Jay Powell's window of opportunity to bring the interest expense for United States taxpayers down is quickly approaching. So of course, there's a lot of fear-based rhetoric and narratives being thrown around regarding everything that's happening at the moment. A lot of it's got to do with feelings and expectations, but just looking at some key raw data that we also got out today that was buried in there amongst the headline. Personal spending actually holding up, even though consumers are very worried. Still at a 0.4% month-over-month increase, and it's going out 3 years. We've seen plenty of months lower than that. But more importantly, and almost completely ignored today, was personal income just printed the highest month-over-month growth we've seen in the last year, coming in at 0.8%. That was double what economists were expecting at 0.4%. And again, just zooming out to 3 years here, That's one of the highest prints we've had this entire bull market. So whilst yes, consumers, or at least a lot of them, are worried, are fearful, some of them may indeed pull back on their discretionary spending here, let things cool down a bit. They're watching their portfolios pull back a bit, maybe going to hold off, find that new discretionary purchase for a month or two. But the key driver of people's spending, their income, is not only holding up, it's accelerating on the upside. And so if this was falling off a cliff, that's a signal that would make me lean a bit more bearish, at least in the short medium term. But we're just not seeing it here. So just following the raw data versus the headlines paints a very different picture of what's going on right now. And there's a look at the 2-year government bond yield, sharply pulling back here today, 391. And so looking at this and Fed Fund futures, the market doesn't seem to be worrying too much about inflation, like many people are saying. But no doubt there's still a growth scare going on, at least, because we can also see that in growth stocks continuing to come under pressure. But just moving on, we got a new IPO today, CoreWeave, a pure play on AI, rapidly growing AI cloud company, with all of its revenue coming from cloud rentals of AI servers that use NVIDIA chips. NVIDIA actually purchased $250 million at the IPO price. I think they had to help them out in this really weak tape. But the stock literally finished trading exactly to the penny of where the IPO was priced, $40 per share on 41 million shares traded today. And just going down to the 5-minute chart did come with a bit of volatility, getting down to 37.5, then going right back up to almost 42 there. And just looking at some other key stocks, Apple turning back down here, but not as bad as Microsoft. Also going to be testing those support levels come early next week, along with Amazon and Meta as well. All these big stocks sitting right at big key support zone. Tesla actually holding up a bit better, considering how normally volatile it is. Did get the news this week of 25% tariffs on all autos not made in the States, which actually benefits Tesla the most. And we do have the latest delivery numbers coming on Tuesday, which it should be no surprise if they come in soft. European sales have been low, as a lot of consumers around the world wait for the new Model Y, which we've had really positive initial reports on. Okay, now on to the stock I said at the start of this video, which is actually the best performing kind of large mega cap tech related stock so far this year. That's Uber. Stock's up 17% year to date, whilst the market's been going the other way. Getting some positive developments. Like I said, if we are moving from that stage of phase 1 AI, the infrastructure build out, into stage 2, where the cost to run AI is a lot cheaper, it's going to benefit the companies that can integrate that hardware into their products and services. And I think Uber is definitely going to be one of them. It's already started. They've partnered with Google's Waymo and Avride to put self-driving cabs on the road, moving people, food, and many other different types of products around the economy. This is inevitable. It will happen regardless of tariffs, regardless of people's fears, regardless of calls for a recession. Automated robo-taxis are the future, and we're right on the doorstep of that as I speak. With a healthy market already developing, Uber, Waymo, Tesla robo-taxis, and likely a few others are all going to be competing in what is set to be a very large and profitable business. And so Uber had been a few years back trying to develop their own automated EVs, but I think they made the right move by giving up on that and instead just looking to partner with the companies that develop them and integrate their already massive and dominant global platform with other companies' hardware. And of course, this is all still early days, but remember, stock markets are forward-looking, and Uber isn't just about taking you from point A to point B. They can pretty much transport anything nowadays. Also getting into boating and flying. You can get stuff delivered from your local hardware shop. In addition to your groceries, as urbanization continues around the world, less and less people will own cars and instead rely on automated robo-taxis to get around and get goods delivered to them. And maybe that's why the market is actually holding up Uber, like I said, a lot better than most other big tech-related stocks over 150 billion market cap, and why I continue to plan on adding to my long-term investment in Uber. One of my most top conviction positions, as I think both Uber, Tesla, and Waymo can all succeed in this industry going forward. And so I think it's inevitable Uber will be a multi-trillion-dollar company in the next 10-15 years and should make for good returns. And just a bit of a follow-up on the entrepreneur shares, private public crossover ETF that I mentioned last Thursday. So this fund's largest holding is actually in private shares of SpaceX, currently about 11% of the fund. And I did get a few questions about this fund because they have a limit on what percentage of the fund can be in private shares, not listed on the market, because they've got 32 holdings, with 30 of them being publicly traded shares like Alphabet, Nvidia, DoorDash, DraftKings, and so on. Well, the way I understand it is yes, they can't go past 15%. They've got about 11% in SpaceX, about another 1% in Klarna. If those private companies were revalued to the upside and it took their position above 15%, they may have to indeed sell some shares, but I believe they'll try and avoid that, but it can go the other way as well. well. They've only got a bit over $300 million assets under management. If that were to grow, that would naturally decrease the percentage held in SpaceX because it's a fixed number of shares, whereas they can take that extra AUM and just invest it in the rest of their publicly held shares. And also what happens when SpaceX inevitably IPOs, goes from private to public. Well, again, the way I understand it is this fund's private shares in SpaceX would convert from private equity to public equity. So when SpaceX trades on the market, this fund would own public shares. They would then have daily public market liquidity. But either way, that's all just technical stuff. Main reason I invested in this fund is because it gives me exposure to SpaceX, along with dozens of other global digital platform stocks as they focus on entrepreneurial companies. Okay, guys, just wrapping it up here. We are set for a volatile start to next week. Looking at the VIX one day, that is quite steep backwardation we've got going on here. 25.4. It's almost 4 full points over the VIX 30 day. So we've got this D-Day on Wednesday, April 2nd, global reciprocal tariffs. Whilst the SPY is coming back down and what looks likely to at least be a retest of the low we got a week and a half ago, as peak pessimism continues. So Monday, Tuesday, going into Wednesday, tariffs will be pivotal. Will the market form a double bottom and those bullish divergences play out? Will we get any last minute deals on tariff negotiation? Will other countries bite back and announce new retaliatory tariffs? Because if that were to happen, then for sure, it shouldn't be any surprise to see the S&P 500 come down and test 5,400 as we may get another swing low in this correction. Certainly not the best candle to finish the week on here. Looking on the weekly chart, bit of a bearish engulfing there as we approach this pivotal event in the markets. But like I showed you, it's really fear and expectations of bad things that are causing this. Remember, we just saw people's income give us the best print in over a year. People are still making money, but indeed, they may not want to spend a lot of it right now. But what happens if things all calm down? We may see a bit of pent-up demand later on in Q2. And the next big event will be Q1 earnings, which kick off in a few weeks. Only got one last trading day of this quarter on Monday. Could definitely be an interesting day. But that's a wrap for this week. Thanks very much for tuning in. And if you enjoyed this video, think about hitting that like button and subscribing to this channel so these videos show up in your feed every day. And I'll keep doing my best to keep you updated on everything important happening in the markets, along with my analysis and opinion on it all. And as always, you're welcome to share your thoughts in the comments below this video. Have a relaxing weekend, and I'll see you back here again for what's no doubt going to be an interesting Monday. Cheers.